Alright, everybody, welcome back to another video. Just want to say thank you so much for spending your time with me here today. And I hope that you get something worth of value today. So today that we're talking about, the title of this video is specifically going to be What the Rich Don't Want You to Know, How to Invest. And it's not clickbait. We are going to talk about ways to invest, and we're just going to talk about the basics, basically, right? I actually don't need these headphones on now that I think about it. They're not even turned on, so that's great. But we're basically just going to talk about the basics of investing, what investing is, how to do it and how not to do it. Because there's a paradigm out there, or there's a philosophy that it's only for the wealthy. Only the wealthy can invest. Investing isn't for me. Investing, I don't understand it. What does it look like? How do you invest? What should you invest in, right? Like, what are some ways to invest? What are some companies to invest in? What software do I use to invest? Does it just come out of my bank account? Is it something I have to watch daily? What's buy high and sell low, or sell low, buy high? What does that mean? Like, what does any of that actually mean? So if you have any of those questions, you've definitely come to the right place. You've definitely come to the right place. So in today's video, we're going to cover a little bit about, what investing is, what it should be, what it is today, and what it shouldn't be. And we'll just, get a good deep dive into it, but we won't go too deep, okay? We're not going to go too in depth of, I don't understand this, and we're not going to use any fancy terminology that would be used by, investors or anything like that. We're just going to be bare bones minimum. We're going to go over things together, and hopefully you get some education and some knowledge out of it. We are not streaming this right now, but I did like the overlay, so I thought I'd keep that up. So, but let's dive right on in. So, if the first thing that I have up right here is I have Yahoo Finance up, okay? And why do I have Yahoo Finance up? Because there's multiple different places that you can look at prices of stock, but I personally just like Yahoo Finance's layout. I don't actually use Yahoo for anything, so I'm not a goat to them or anything like that. But I personally just like their how their layout is, what it looks like, and let's just jump right on into it, okay? Also, make sure that you're followed on all the social media handles: Instagram, Facebook. I don't have Twitter, but Twitter, and you're subscribed to the channel as well. All right, so let's move me out the way real quick, which I will do that right now, and we will jump right on into it. So let's put me over here, and we're going to shrink me down a little bit, because I don't need to be the forefront of this. This is an educational video, and I want it to remain educational, of course. So let's do that. I'm going to shrink you down a tiny bit. All right, boom. All right, so we're on Yahoo Finance. Well, what is Yahoo Finance? So Yahoo Finance basically just shows you it's a website that shows prices of stocks, okay? So if we look at this real quick, we have symbols right here, last price, change, and change percentage. And if you're new to stocks, you might be freaking out. You're like, this is a lot of numbers. Like, what does this actually mean? Well, let's jump into the most controversial stock that I talk about, Tesla. So TSLA stands for Tesla, and it says right here, Tesla Inc. It says last price. So the market is open right now at the time of this video, which is why it's changing. But the last price just means that the last time the stock market was open, this is the price. Change means from when the day started, is it either up, which would be green, or down, which would be red. Green is good, generally, and red is bad, generally. And the percentage change, that's just if you want to see the percentage of the stock, like for example, Amazon, AMZN, is up $56 or 1.69% today, okay? And these are all of my recently viewed, and they're going to be changed for everybody. There's different portfolios and everything like that you can have saved. But I'm not here to talk about, why Yahoo Finance is good. I'm here to talk to you about what it is investing and why you should do it, and some basics on it. So let's click on Tesla real quick. So if we look on Tesla's page right here, this is Yahoo Finance, obviously, like we talked about, and then TSLA. That's the tag for. That's the tag for the company Tesla. Every company has a tag or ticker symbol, is what it's actually called, which is A ticker is something that changes, and a symbol is obviously something to represent the fact that it's changing, okay? So if we look right here, TSLA means Tesla. Tesla Inc. NASDAQ is just a market. So think of it when you want to buy apples or oranges. Most people go to the grocery store. Some people go to farmers markets. Well, what are farmers markets? Farmers markets are, it's one company that has a whole bunch of other companies inside of it, right? Like you're going to buy an apple, but chances are it's not from that farmers market. It's from Bob Jones apple orchard. So you would buy from Bob Jones, but still at the market. So don't pay too much attention to the market types. They don't matter too much. And for 99% of people out there, you can stop right now at this video, because what you should do is buy an index fund. An index fund is what these things are at the top right here. So like an S&P 500. This is an index fund of it's a big conglomerate of a whole bunch of different companies, okay? Basically. And this grows pretty steadily. This one's 13% for the day. They grow on average about 15% a year. And you throw your money in an index fund like this, and it grows. You do absolutely nothing to it. You just buy it and keep buying it. And you sell when you want to be out, right? So that's on average, most people should just be an index fund. If you want to manage your own funds, then you should get a better return than an index fund. I actually think some index funds are on average about 10%. So you probably want about 13%, right? You want something to be worth your time, okay? So Tesla, right now, if you look at this and you're looking and you're like, oh my goodness, this is just so much. Like, I don't understand any of this. Calm down. We're going to go over it together. And the reason the rich are wealthy, here's the first hidden point. The reason the wealthy are rich, is because they invest their money, right? The smart people invest their money into assets as opposed to liabilities, which we've definitely talked about in previous videos. So you need to invest in assets, but the hard part is getting the good price for the asset, okay? So, for example, you need to get Tesla at a good price, right? You don't want to overpay for something. For example, a lot of people lose in the stock market. Why? Because they're going to buy Tesla for $1,000 as of right here, this price, and just be like, okay, it's either going to go up or go down, and gamble with it. And then if you look at just the year to date, you could have got it for as cheap as $600, and now it's $1,000. So if you bought it for $600 and now it's $1,000, you made good money. But if you bought for it was at almost $1,100 today, and now it's at $1,016. See, it's down 8% today. So if you bought for the high of today, you would be negative, pretty close to $80. So you can't. It's not just as simple as buy and pray, right? So let's go over what this is. Previous close just means yesterday's close, when the market closed. How much was it? $1,024. Open. How much was it when it opened? So when the stock market opens at 9:30, this is what the price was set as. There are things you can buy and sell out of stock hours, which is why this number is different than that number. A bid and an ask. All right, I wouldn't pay too much attention to that. Ask is the asking price. Bid is if you want to bid on it. It gets complicated, so don't even worry about that. Days range. So if you look, the days range from the start of the day to the end of the day. This is the lowest it was of $1,000, and the highest it was of $1,094. So if you bought today at the $1,094, you've lost money. It's the amount of volume people buying and selling the stock. And this is the average volume. Well, if you look at the average volume compared to the normal volume, what does that tell you? It tells you that there's a ton more people today than there were before. More than double. Market cap. Market cap can be deceived and tricked very, very easily. Market cap is just all of the price of the shares times by how many shares. Therefore, their market cap is $1 trillion at the timing of this video. PE. PE is called price to earnings ratio. And a price to earnings ratio is what the price is of the stock to how much it's earned in capital. So a PE of 331 is stupid high. I think it's the highest I've ever seen in a company, which means that the only thing that can justify that high of a PE is growth. So if you think, excuse me, the company is going to grow that much, and it's going to grow at 331 times earnings, because that's what this is, price to PE is price to earnings ratio. So what that means is this company is selling at 331 times its earnings. Okay. EPS isn't important. Earnings date is, these are the dates that they declare what their earnings were. Forward and dividend yield, there is no dividend. And then the 1 year target estimate, and I wouldn't even pay attention to that. If you think that analysts are correct most of the time, then I would pay attention to these things right down here. If you don't, which I don't, then I wouldn't take this too seriously. For example, they think the analysts think that Tesla is overvalued, and I also believe that it is. All right, so then we have a chart right here. So we have a 1D, 5D, 1M, 6M, YTD, etc. So this is time frames. 1D is 1 day, 5 day, 1 month, 6 month, year to date, 1 year, 5 year, and the max. Okay, and then if we look down, you should never buy a stock without looking at its finances, is what I definitely believe, because I don't believe in gambling, or I don't personally gamble. Okay, so if we look down here, we can see its earnings. So these are the estimates on bottom and the actual on top. And this is earning per share. So, 0.80 estimate $1, 0.93 estimate, which doesn't actually mean much to you. What you should actually be looking at is the finances, and we're going to go into a deep depth dive on that. So you have annually and you have quarterly. So this is just a very easy chart to read of, has the company made money? If so, how much money? For example, in 2017, Tesla made $11.76 billion in revenue, but they actually profited, which would be earnings, negative $1.96 billion, so negative $2 billion, okay? So if we look over here, the next month of 2018, okay, they've made in revenue $21 billion, but still lost about $1 billion in earnings. So they are negative $3 billion at the moment. The revenue, they made $25 billion, but earnings negative $862 million. Okay, and then in 2020, which is the most year reported, because obviously we've passed 2020, they made $721 million in earnings, and their revenue was $31 billion. So if you believe that they're going to keep jumping up like this, 2018 and 2019, they didn't change too much. But if you believe that they're going to continue to jump up and you think that this price is justified, then purchase it for this price. And it's as simple as, when the price gets to a number you're comfortable at selling, you sell. And it's as simple as, when it's at a number you're comfortable at buying, you buy. So let's go deeper into the finances. The reason I like Yahoo Finance specifically is because they have a finance tab and they break down everything. TTM is trailing 10 months, or no, I think it's trailing 12 months. I know it's trailing, I just don't know how long it trails. So then we have 2020 right here, 2019, 18, and 17, and TTM is what it's, as of today's date, shot out with an estimate. So, for example, let's do 2020, for example. Total revenue, they made this, but the cost of the revenue was this. So the gross profit was that, and after gross profit, they have to take out expenditures and everything, and that's how in 2020 they got to $721 million after all was said and done. But the thing so you want to look at the income sheet of how much do they actually make and how much do they spend. Then you want to go to the balance sheet and you want to say, okay, well, how many assets do they have? Well, this says that their total assets, which is current assets and total non-asset classes, liabilities, etc., is 52. And these numbers are in, I think, thousands, so it's easier to read. So total assets of 52, total liabilities of 29, and total gross equity of 29, total capitalization of 30, common stock. Common stock is how much stock equity they have. Working capital is how much they have physically working for them. Invested is obviously invested. This is pretty basic stuff, right? Total debt of 13 bill. I'm pretty sure that's that 13 billion. Or maybe it's 132 billion. It's one of the two. So then you say, okay, now that I've looked at the finances of this company, is this company, TSLA or Tesla Inc., worth what the market says it's worth right now? And you need to remember that in the short term, the stock market is a voting machine where people basically say, I'll pay this price and this price and this price, but I'll stop at this price. So everybody votes on what they think it's worth. But long term, if you look at all graphs, they all have a dip down because in the long term, it's a weighing machine. It comes back to its original value, right? So Tesla. And you're not just buying a ticker symbol. Most people, they're like, oh, I'll just buy, 7 shares of TSLA, right? No, you're buying 7 shares of a physical company called Tesla. So when they do good, sales-wise, and make money, you make money. If they do poorly, you lose money. You are purchasing a percentage, although it be very small, of the company, right? So let's go back to the main page real quick, and let's look at some other companies that I was previously looking at. Okay. All right. So let's do NIO, another electric car manufacturer or company. Let's do a 1 month. All right, we'll keep this pretty simple. The lowest that it was in the month was October 4th at $33 a share. Okay. The highest it's been is $42.36 on October 22nd, 2021. Obviously, if it was as simple as you get in on a low and you sell on a high, then everybody would be wealthy. We don't know when the lows are going to happen. We don't know when the highs are going to happen. So what do we know? We can value the company, and if it's at that price, we buy. And if it's not at that price, we don't buy. We just hold. Then we purchase the stock, and then when it gets to a position or a price that we like, we sell. For example, best case scenario for this company. I also don't own this company. Don't recommend it, but do your own research and do what you got to do. Best case scenario, you get in at $37.51 and you get out at $56.67. You subtract it. That's how much profit you made per share, right? But it's not as simple as that because, for example, this obviously it's been a rough ride. There's been up and down and up and down and up and down. And their PE, they don't even have a PE on here. We could Google it if we really wanted to. The PE to this company is also high. Well, let's look at a company that somebody hyped up, people lost millions of dollars on, just because they didn't do their research. Okay? So this is a don't do. Somebody says, yo, man, I need you to get in on SPCE. Is the ticker price the ticker symbol, and the company is called Virgin Galactic Holdings Inc. And this company is literally gonna shuttle you to the moon and back, like to space, just like you would on an airplane. Okay. It's only at the time that this was being hyped up, it was about $60. Yeah, $54.34. It was $54.34 at the time that person shot the video. And actually, I did a reaction to this on the YouTube channel, so make sure you're subscribed if you like that kind of content. But $54.34. Everybody was hyped up. They bought it. And then what happened? Well, February 1st, I think it's a 1 year. By the 22nd, not even a month later, it dropped to $27 a share. And then it dropped again. Another 10 days or 14 days later to $16 a share. And now it's steadily going slowly back up, and it's at $19 right now. So if you bought when they hyped you up at $54 and it's now $20, how much would you have made? Well, obviously, you'd lose. You'd be at like, what, $30? You'd lose $30 per share. So you bought 10 shares. That's obviously 30 times 10, 300. And the more shares you buy, obviously, the more money you can make and also lose, right? Because obviously more money is invested. So let's look at the earnings. Okay. When have they ever actually hit their earnings? No. Well, that doesn't actually mean much. This is what actually means the most, the finances. You shouldn't buy a company if you, 1, don't understand the company and what it does, and 2, the finance behind the company. For example, this company that does space travel, I don't understand space travel, so I have no business buying space travel stock. Why? Because I don't know how they make money besides selling tickets to, go to the moon. Have they had any successful launches? I don't know. I don't understand anything about the company, so why would I buy a portion of the stock? You know what I mean? So let's just look at this real quick. 2017 to 2020. We've got 4 years here. So in 2017, they revenue of $2 million, okay? But their earnings was negative $138 million. So they lost $136 million, okay? Revenue, $2.85 million in 2018, but they lost $138 million. 2019, they made $3.78 million, but lost $215 million. And in 2020, they made $238,000, which some people make more than that in a year, and their earnings were negative $644.89 million. So if somebody was like, yo, I want you to buy this company. Let's approach it from a different point of view. Say you have a friend, okay? And this friend owns a company, right? So your friend say they sell apples, okay? Because we just used that analogy earlier. So they sell apples. And they're like, yo, I want you to invest in my company. Okay, well, how much money have you made off of your apples? Oh, so I made $2 million. Oh, great. But how much did that cost you? You need to ask that question, because if he's like, yo, I've made $2 million off of apples, you're like, oh, great. But you give him your money, and he's like, he didn't tell you, oh, yeah, but I lost $138 million on the apples, due to supplies and stuff, right? Then you'd be like, whoa. Just like, in everyday life, there's a person next to you who's like, hey, can I borrow money? Sure, here's $1 million. By the way, I've got $138 other $1 million of loans, and I've never paid any back, right? Like, you need to look at its finances. So you wouldn't invest in a company that's losing tons of money, right? Because eventually it's going to go out of business, going to go bankrupt. It's a dying company. Look at the stock. Like, that speaks for itself, right? Like, if you didn't even know this company and you saw this as their finances, would you personally invest in it? Hopefully the answer is no, right? Like, it doesn't matter which company it was. If they were losing this amount of money, then clearly you should not invest in it. But people just listen to the hype, and they're like, oh, I'll buy it for $60. It's going to the moon, literally, and now it's at $20, and people have lost millions of dollars on it, right? So you need to be cautious and be careful on what you're investing and how you're investing in it, right? So what have we learned so far? We learned that the ticker symbol isn't just a ticker symbol. You're buying a portion of a company at a price that you think is reasonable, and it's up to you on how you want to define reasonable. There's plenty of different ways to value a company, all of which are going to be different numbers, but generally in the same ballpark, depending on your method, right? And then you buy it for a price that you think it's worth or below its worth, and then you sell when it's above its worth, obviously. For example, a great one would be Alibaba right here. If we look at today, it's $170 right now. Well, how big is the company? $465 billion. So it's a big company. Okay. Well, let's look at the finances. Do they make money, right? Let's look at this chart. So the last 4 years, they've, made $64 billion in profit. They've made $87 billion. They made $150 billion. They did $717 billion in revenue, and they made $150 billion. Excuse me. So are they making money? Oh, yeah. They're making tons of money. Let's look at their balance sheet. Total assets, a fat stack. Total liabilities, total debt, super small. So what does that mean? When a company has a ton of money and not a lot of liabilities, it's hard for them to go out of business because they have money to cover everything, right? Look at their cash flow. All right, so 2021, operating cash flow, how much they've used to invest, financing, and end. So they have this much left over at the end, 356, even after investing $244 million. So this company's really good about their expenses. And here's their earnings. Estimate 218 and their actual of 278. So their earnings are also, going up. So if we look at, and then we can look at historical data, we can look at what the analysts say. Let's look at the analysts, what they say. I don't really give a shit, but let's see what they think, okay? So let's go back a couple pages. They think it's near fair value, of $170, okay? And the PE is 20 compared to Tesla's 330. So this is much more down to earth, right? For example, I believe personally that Alibaba at 170, am I going to buy it at 170? Yes. What point do I stop buying it? I think the valuation of the company, if you just plug it into a valuation tool, you can get anywhere from $400 to $800, right? And that's just growing at its current rate, or even if it slows down. So at $170, I think it's a steal, personally, and I'm personally going to buy it. I can't give you any recommendations legally, so I'm not telling you to do that. But, do your own 2 cents on the matter. Look up the stock and see if it's a purchase for you, okay? And if we look at they think it's going to go long-term down, mid-term, it's going to go up short-term, it's going to just go to the right, which means it's not going to grow too much. Then they have either bullish or bearish patterns, which is either good or bad. And that's, a whole nother realm of things. So if we do recommended trends, this is what, analysts are saying. And again, I think about analysts' words are about as, truthful as a politician's. So take that for what you will. But so it looks like maybe 1 or 2 people are saying sell. But most of the people are saying buy, strong buy, and hold. So, and then on a 1 to a 5, 5 being sell now, 1 being a strong buy, it's about a 1.8. So people think that it's a pretty good buy. Okay. Lowest it's been in the last 52 weeks is $134. Highest it's been is $335, and it's current at $170. I think this price is a steal, personally, for me. These are its, maintains and stuff. It doesn't actually matter. Alibaba owns a whole bunch of companies. We knew that, and then there's news all about it over here. So the biggest thing that we've learned today is you need to buy a company for what you think is worth and then sell when you believe that it's at an adequate price. And there's tons of different ways to do that. Personally, I'm a value investor, and what that means is I want to buy something for a good price and sell for a reasonable price. And what that means is I want to buy a company that's a $100 company that's worth $100. I want to buy it for $80. So absolute worst case scenario, I sell for the reasonable price of $100 that it's actually worth, and I've made money because you make your money off of the purchase and not the sale. For example, then I don't have to pray that it goes to the moon in order to make money, right? I don't have to pray, I hope it just keeps going up, keep going up. That means absolute worst case scenario, right? I am in the positive. And say it does go to the moon, well, great. It's gone to the moon even more than what I thought it was going to do, right? So if we just, go through real quick, you need to ask yourself, let's do Netflix. First of all, ask yourself, is Netflix, would you personally pay $664 for 1 share of Netflix? Well, first thing that you have to do is you have to look at other companies in the same market that do the same thing and ask yourself, is this reasonable and comparative to other companies that do the same thing, that are other streaming companies, right? Because if you just look at Berkshire Hathaway at $430,000 per share, okay, and you compare it to Amazon, what's more expensive? Well, $450,000 seems a lot more than $3,000 per share. Well, no, the $450,000 is actually cheaper because you're getting more for the money, etc. So, actually, Netflix is not a really good comparison because they don't have a lot of things to compare it to, right? Like you have Hulu, but that's owned by Disney, so it's all in the Disney stock, and they have Disney Plus, but that's also in the Disney share. So let's do something. Let's look at Toyota, right? Because we can compare Toyota to Tesla, or Toyota to other companies, right? Toyota is $173 per share. Okay. Well, and they're $240 billion is their market cap, and their finances are this. If you want to glance real quick, they do make money. They make a good amount of money. Okay. $173, and this is what they make. Okay. Their PE is 9. It means price to earning ratios. They sell for 9 times what they're actually making. Okay. And then Tesla. what was Tesla? So let's do Tesla Yahoo Finance. Let's get that up real quick. Tesla, 337 PE. Okay, so selling for 337 times earnings as opposed to Toyota's 9. Okay, and they're worth 1 trillion. Toyota's worth 240 billion. Okay, let's do Ford. Not Toyota Finance. Yahoo Finance. All right. So we're at Ford. Their PE is 18, which is higher than Toyota's 9, and they're selling for $15 a share. Okay, what's their market cap? Their market cap's also quite a bit lower at $63 billion. Okay, what are some other car companies? Well, let's do Volkswagen Yahoo. I'm butchering this. Finance. All right, Volkswagen. They're worth $34 a share at a PE of 8. And it's pretty consistent. So we need to compare, is this price, which is the price today, which is going to change tomorrow, is it worth me buying now, selling now, or holding, right? That's the question that you should be asking yourself. So you wake up in the morning, you say, I want to buy some stock, right? Because I need to invest if I want to make any money later down the road, right? And you do. I would say that's true. So you say, okay, I want to buy a Ford share, but I don't know if $15 is a steal or if I'm getting scammed. So then you look at other companies. You look at, okay, well, Volkswagen sells for $34 and they're at $170 billion market cap. And Tesla sells at $1,000. They're at $1 trillion market cap. And Toyota sells at $173 and a $240 billion market cap. So we're like, okay, is it in the realm of a PE of 18? Well, 18 seems a little high to me, right? Like Volkswagen's 8. And Toyota is 9. So it should be somewhere around, anywhere from 8 to 13 would be considered reasonable for something like that. The only way that a higher PE would be considered reasonable is if the growth was there. For example, they could get away, like Tesla, I'm saying quotes, can get away with a PE of 337 because it's a growth stock. So as soon as that growth stops or slows, it needs to come down or it's considered overpriced. Okay? So back to Ford. Okay, so we're at Ford. It's $15.93 right now. Its market cap is this. The PE is a little too high. Let's look, is the company making money? That's the next step. Okay, 2017, they made $7 billion out of 156. In 2018, they made 3 out of 160. In 2019, they made $50 million out of 155, and in 2020, they lost $1.2 billion. Okay, so they were making money, and now it's declining. Why would it be declining? Well, because of chip shortages, between manufacturing issues, between other companies and other cars in the market, right? Like Teslas are being bought, and they're switching over to electric vehicles. Like, you know what I mean? Like, there's lots of different factors that you have to put in, right? So, and then this is what the analysts say. They think it's an undervalue. I think that this price is overpriced. Well, how? When it says it's undervalued here and it's a strong buy here. Well, think about it. Let's just do, year to date. 1 year. It's at $15.94. The lowest it's been is about $8. Okay, so it's gone pretty low and it's growing. It's getting higher, right? Yes. Okay. Well, let's ask some other questions. Why? Why did it go down? Could it be earnings? Could it be debt? Could it be, there's lots of different factors. Do you believe that a PE of 18 should be applied to this company? No. I believe that it should be more like 8, 9, like Toyota and BMW. So that means that they're selling about double price to earning ratio than it should be, which means it's probably twice overpriced. So the value of this company is somewhere around $8, right? So if the value of the company is $8 and it's $16, would you buy? Well, I personally would not, because if it's over the value, then why would I buy it? And just pray that it goes up, because obviously it could also go down, right? Do I think Tesla is worth $1,000 a share? No. Is there money to be made in short term and maybe even midterm for Tesla? Yeah, 100%. But I'm not making that money because I believe I'm not going to pay more for something. You know what I mean? Like, PE of 337 is crazy. I don't think there's any other company with a higher PE right now. Like, let's check out Amazon. Amazon's PE is 57. Apple's PE is 29. Tech companies tend to have higher price to earnings ratio because their growth is a lot higher, right? It's really easy to grow in a tech company as opposed to, a farming company, right? Because they can make more software, they can get in-app purchases, they can make money that doesn't actually cost them things. Apples take seeds, take planting, like the physical fruit, and they keep making money here. Let's go to any big company that you can think of, or any company has a lower PE than 337. That's just preposterous to even think. Let's look at Google. Google's PE is 92, which is stupid high, but it's a growth company, right? Like, they're growing quite a bit. Everybody knows Google and everybody uses Google, so I can justify that. And their PE is 30. It's not 92. That was EPS. It's 30. So if all these companies' PEs are around that, and this is at 336, 100 times higher, is it worth it? Well, you have to think to yourself. For example, Tesla's market cap, fun fact, is higher than every other car company combined. Well, do they make more cars? No. Is there growth there? Yes. But can you overpay for growth? Yes, 100%. So I'm going over a little bit people's heads right now. So we're gonna go back to the basics. Imagine every day there's a guy that knocks on your door, just like we say the olden days when they would knock on your door, right, for milk or something like that. There's a gentleman that knocks on your door every single day, and he asks you, would you like to buy a stock or sell a stock or hold a stock? Those are your three options: buy, sell, hold. And every day he gives you the price of what he's willing to pay for said stock. Let's switch back to Ford. Gentleman comes to you and says, hello, today, would you like to buy, sell, or hold? He said, today on the menu I have Ford, right, at $15 a share. Would you like to buy it at $15 a share? Would you like to sell it to me at $15 a share? Or would you like to hold and just not do anything? Well, I would like to hold today because I don't know, the market. I haven't even been in the market for 30 days. I'm just going to hold it for a month and see what happens, okay? Every single day, that same gentleman knocks on your door and asks you, do you want to buy for this price? And you can also sell it to me at that price or hold it. I'm going to continue to hold. Now, say, let's do a 5-day. This is perfect. Day 1. This goes over, yes, Wednesday. Okay. On Wednesday, Mr. Market knocks on your door and says, would you like to buy Ford for $15.99 a share or $16 per share? I would not. Thank you very much. I will hold. Have a good day. Tuesday, he comes to you and says, would you like to buy it at $16.40 a share? I'm going to say, sure, I'll buy it to you at $16.40. I really wanted to get in on Wednesday, but I didn't have the money. So, I'll get in on Tuesday at $16.40. Okay. So that's Thursday. Friday comes around. He says, hello, would you like to sell it or buy it at $16.35 a share? Well, sorry, I bought it at $16.40, so I would lose 5 cents if I sold it. So I'm going to hold it. I'm not going to buy any more. I'm just going to hold. Monday comes around. $16.11. He knocks on your door and says, hello, would you like to buy this share at $16.11? You say, yes, I would like to buy it at this price. No, I would not. Or I would like to sell you my current shares at that price. And repeat every single day. If you look on just this 5-day chart from Wednesday to Tuesday, excuse me, I bought on a high, which means at $16.40, a share, none of these days I would get any of my money back and I would actually be losing money. If you value the company at, let's do a year to date, say Mr. Market comes to you every single day, right? And one day he says, would you like to buy Ford at $9 per share today? Or sell it to me at $9 per share today? And you say, I believe that Ford is worth $9. I will buy, let's do 100 shares at $9. Okay, well then you give him $900. That's simple math. And he gives you the shares. Okay, so now you have 100 shares of Ford. Paid $900. and it's worth $9. Every single day, he's going to continue to ask you, would you like to buy, sell, or hold? And you're going to hold, presumably, until you believe that it's an adequate amount of money for you to make. For example, you bought it $9, okay? 1 month, it's January, February, March, April. Let's do 4 months pass. Mr. Market knocks on your door again and says, hello, would you like to buy for $15.92, sell for $15.92, or just hold? And now you have the position to say, well, I bought for $9, which was about the value, and now it's above value. So do I want to sell it for above value and make, $6.90 profit? Would I like to let it grow even more, or would I just like to, to cash out and make my money? And if you did $15.90, you would make some money. But if we go to a max chart, now let's do a 5-year chart. Let's glance at this real quick. Yeah, we want a max chart. So back in 1998, right, people were buying Ford for $28.65 a share. Well, has Ford made more money now than they did back then? I think they probably made less because, back then everybody was all about Ford. But $28.65. So if you bought for $28.65 now, and then Mr. Market said, oh, well, it's worth $15.90 today, would you buy or sell? Well, obviously you would hold, or you would get out and just lose the money and make sure that it's not lower, right? You would cut your losses. But the highest that this company's been is $31.39, and the lowest it's been is, $2.65. So you clearly cannot just say, high, low, average, and try to go off from there, right? You need to do your due diligence and say, how much is it worth? Should I buy it today? Is it worth today's price? For example, if we go back to the 1 year and we do the analogy that we just did, and you bought for $9 and you sold for, on June 7th, Mr. Market came to your door and knocked it and said, hey, it's worth $15.28 a share right now. Would you like to sell? And you say, yes, sign me up. I've made almost double my money. I will sell, I will get out, and I will take my profits and I will leave, right? Then you would be making a very handsome sum of money depending on how many you bought. Let's do simple math real quick. So you bought for $9 a share, and it's 15.28 minus 9. You've made $6.28 per share. Times that by 10. You've made we bought $900, $600, right? You made $600. Is that some math? So you've almost doubled your money, right? So then you just get out and you go to the next stock, or you hold until you believe that it's not going to go up any further. For example, Tesla right now, if you look at just the 6 months, it's going up. It's going up. But if you go the year to date, let's do the 5 year. Look at this. It went from $498 and then crashed down, and then $677 and crashed down and crashed down. So you have to obviously prepare for the crashes, but you have to buy the company for what you think it's worth. We'll do one more company and then I'll end the video. So let's do, what's a great company? Let's do a company that I own. How about that? Let's go to Baba, because I think that it's a tech company. It's an online selling company. I think that this is a very great way to. Let's do this one, and then let's do Baba, and let's do this. All right, now all this is going to do is you're going to put in assumptions, and it's going to tell you what it's worth off of those assumptions. Okay? So let's go back to this real quick. $170 a share. Is it worth it? Well, let's ask ourselves. So low, medium, high. Okay? So on the low end, how much money do you want to make? On the high end, how much money do you want to make? So it's growing at 40% in the last year, 44% on average for the last 5 years. Well, let's be very conservative about these numbers, okay? Because obviously, worst case scenario, we still want to make money. That's how you play to win, right? Worst case scenario, you make money. Best case scenario, you make a lot of money, right? So let's do, they grow at 20%, 25%, and 30%, which is still lower than their 40%. Share change. Are they going to issue shares, or are they going to buy back shares? Baba actually said they're buying back shares because it's at a lower price right now. And what a share buyback is basically a company can use its shares that they have of common stock that you would buy for $170 a share, and they could use it as a form of debt, right? So instead of taking out a loan for $1,000, they could issue, 6 shares, 5 shares, and they would then pay back the share difference. You know what I mean? So It's a smarter way for them to take out debt with no cost to them. So generally, when the stocks are really high, they issue shares, and when they're really low, they buy back shares, or should be buying back shares. Well, why would they not buy when it's at a high? For example, say if we go back to this max chart, Alibaba hit a high of $300 per share. Well, if it's worth $150 and they bought it back for $300, they're losing half their money. So they're going to wait to a smart time to buy back the shares. And when they buy back the shares, it just means you own a bigger piece of the pie. Think of you own 1/10 of a company, and you obviously own 1/10 or 10%. And then say they issue another 10 shares. Well, now you own half of your 10%. You own one-fifth, right? Or sorry, 1/5 is the bigger number. You own 1/20th. So that's the silent killer. So say they buy back 0. They don't buy anything back. They buy back 1, and then they buy back 2. Profit margins. How much does the company profit? Like, what percentage is their profit margin? Their profit margin in the last 5 years was 26%, and in the last year it's about 18.5. So let's be very conservative, okay? Let's do, they only make 16%, they make 18, and say they had a great year because everybody's with COVID, they're staying home, 20%, okay? PE, their PE is 19, which is higher than a lot of companies, but also lower than some companies. And 19 is probably pretty close, but let's do 15, 18, and 20, okay? Which means they're selling for 15, 18, and 20%, or 20 times earnings. And then how much money do we want to make? Well, I want 20, 15, 10. Analyze. Oh, and we want, let's do 7 years, 5 years. Are we missing a field? Oh, yeah, profit margin. Oh, I typed in the wrong one. So 16, 18, 20, and then free cash flow. Let's do, looks like it's about 8. Let's just put 18s. 18, 20. Analyze. All right. So if I believe these assumptions, this is what the company's worth. So if I do low, they make 20%. They don't buy back shares at a 16% profit. Then it's worth about $141, which Baba is at 171 right now. Okay. Do I think it's more like the middle one, where they make 25%, they grow 25% over the next 5 years. They buy back just 1% of shares at an 18% profit margin, and I want 15% back, then I buy for this price. That means it's worth $284.46. And then if it's 30, then it's worth this price. Right? So it gives you a range of what they believe that it's worth. For example, if it's $171 an ounce, would I buy it? Like me personally, yes. Why? Because absolute low would be $141, and I would be literally stealing it. Okay? It's only $20 above the steel, like the steel price. 280 is what its mid is, and a high of 524, right? So it's basically a no-brainer, right? And if we change just this to 22%, we're already in the price range of the stock, right? So there's definitely tools that you can use to evaluate a stock. And if we did the same thing on Tesla, we're not even, we'll do that just for the video, and that's, well, I'll cut it short. You guys are you're gonna cry if you look, once you look at Tesla. All right. Say they grow 44%. Let's do a low, middle, high. Low is what I think, and then we'll do and a high is what they think. Okay, let's do that. So I believe it's going to grow probably at 30%. Excuse me. 44, 60. Share change. They're issuing shares like freaking crazy. 5%, 7%, 7.5%. All right, so let's do 7, 6, 5. Profit margin, they've got 7% profit. Let's do that. Free cash flow, which is how much they have to like reinvest and stuff like that. Let's do 5. It's the only positive number. These are all negative numbers. PE of 300, 333, which is what it is, or it's 337 now. And let's do a 400 PE. No, that's too high. 350. And then let's do the same numbers for these. And I want 20, 15, 10. Over the next 5 years, what's it worth? Oh, so if you believe these estimates of they're going to make 30%, they're going to give you 7% shares at a PE of 300, which is the growth rate that we're putting in, then look at this. It's anywhere from $1,000 to $600. But what company has that high of PE? There's no other company that I can think of. So let's be realistic about our PE. Let's do, you know what? Let's do this. Let's do Toyota's PE is 9. That's way too low. Let's do the highest PE we can find on just my recent, which would probably be Amazon. PE of 58. Okay. So let's do 50, 55, and 60. 50, 55, and 60. Well, what's it worth? Oh, look at that. If you believe the PE is around what, Amazon is selling for, if you think it's as hype as Amazon, you can get 1,100 is the absolute high, and the low is $200. Well, if we go to the stock, well, how much is it? It's like $1,020 right now. So would you buy it? Well, no. Why? Because you're $80 away from the high, which means that's the highest that it would be worth. So you're gonna invest $100 to get $80 back or something like that? No. Mid and low. So it's worth anywhere above the low, but between the mid. So it's probably worth $300 a share, if we believe these assumptions. $300 a share. But if it's selling for 1,000, 1,100 or 1,000, would you buy it? Well, no, because it's above the value of the company. You'd just be praying that it's going up. You'd be gambling, right? So make sure that, you're doing your due diligence on the companies that you're investing in. Don't just do it because some random person told you to buy a stock. Make sure that you're looking at the finances of the company, that it's something that it's worth and worth investing, right? You don't necessarily need to know all the fancy terminology of PE, of open bid, of ask, of close, of shorting, of all those things. You simply just need to look and say, is this company worth this compared to other companies? Is it making money? And then what percentage return do I want? Do some simple math, and then you'll get that result. But thanks for watching. If you enjoyed the content, make sure to subscribe and leave a like if you liked the video, genuinely. I think that's all I have for you guys. So I will catch you guys in the next one. Thanks.